Every once in a while, this young man goes on an epic rant on Instagram. He did just that about a week or two ago, right after the NVIDIA earnings. And this rant was about cash on the sidelines. Taylor from LifeGoal Investments, that was fun to watch. I got to admit, I watched that one a couple of times because you were passionate.
It's funny. So let me start this off with a little quiz. I'll give you 4 asset classes, and
Okay.
you tell me which one's going to be the worst performer over the next 10 years.
Oh, over 10 years. Okay.
10
All right.
years. 5, you choose it. 5, 10. I'm not saying 1 year because that's kind of like really unknown. 5 or 10 years out. I'll give
Okay.
you cash,
Mm.
bonds, stocks, or alternatives. Which one's the
What?
worst performer
Oh,
over 5 or 10 years from now?
without question, cash. Without question, cash will be
Okay.
the worst performer.
And that's 100% the right answer to answer because cash is a riskless asset. An asset that has no risk cannot be anticipated that will keep pace with assets that have risk associated with them. It's not to say you can't go out and buy the wrong stock and 10 years
Mhm.
from now be in a worse position, but
Sure.
broadly speaking, that's the case. And then I say to people, what percentage of your portfolio is sitting in cash? And the number of answers that I get right now, upwards of 50, is
Oh,
mind blowing, mind numbing. Your response.
wow. So
Exactly.
that's and again, let's be clear. Your service, what you do at Life Goal Investments, you're interacting with the top 20% of households and families, maybe even higher than that. So if they're telling you that 50% of their money is in cash, I think that tells you two things. And I think it's important. I think we have to talk about this. Why? One, unquestionably, they're scared, right?
Yep.
When consumers go to cash, they're scared.
Yep.
I think that makes sense. But the second thing that it tells me is, especially if it's there for a long time, that's the key. Is it there for a long time? They don't know where to put it. They feel burned, maybe. I don't know. Why the 50% cash?
Yeah, and to be very clear on this, I'm not talking about stuff that is, hey, I'm going to buy a house, I'm going to buy a
Right.
rental, I'm going to buy this. I'm not talking about I'm talking about investable money for the long term. And
Mhm.
50% sitting in cash. And so here's and when I say cash also, I mean CDs, money markets, high yield savings accounts, short-term treasuries. Those are
Yeah.
all bucketed right along with cash for me. And listen, I get it. I'm not numb to the fact that there is a 5% yield to be had in those assets right now. One, if this is taxable money, the first knock on that is you have to understand that's taxed.
Hmm.
No bank is going to come out and say, hey, we'll give you a 5% yield on a savings account. By the way, whatever your ordinary income tax is, that's what you're going to pay on this yield, baby. So at the end of the day, understand that. So if you're in a high tax bracket, that's now yielding sub 3%. If you're in the state of California, watch out.
Mm.
So that's the first knock on it. But the reason that people are sitting in cash, and I understand this, and I'll even call 3-month treasury bills cash, is the yield curve is upside down right now. The yield
Sure.
curve is inverted. For context, that's not normal. Normally, the longer dated bonds are going to give you a higher yield than short term bonds.
Of
Right
course.
now, that's not the case. Short term bonds on the treasury yield curve yield more than every other bond as you push further out. What
Mm.
that's telling us as investors is that the Fed is likely to cut interest rates. That will drive the front end of the yield curve down and make it positively sloped like it historically has been. So now let's take another step at this and say, okay, if you own 3-month treasury bills
Hmm.
and the Fed cuts interest rates, what happens to the price of those 3-month treasuries? Nothing. They go sideways. And when they
Right.
mature in 3 months, they re rack at a lower yield.
Right.
Okay, now let's think about the idiotic idea of going out and buying longer term bonds, like a 10-year treasury out at 4.5%. Okay, if we're thinking about the Fed cutting interest rates, what's going to happen is new 10-year bonds are going to come to market at 3.5%. And what is the market going to do? They're going to begin buying up that 4.5% yielding bond, driving down the yield,
Mhm.
driving up the value. So you
Right.
have to understand what the market is implying based on the shape of the interest rate curve. So yes, you can get a higher yield on the short end of the curve, but when the Fed cuts rates a year from now and they're down 125 bips from where they're at right now, that's your yield. And when you have the scenario with a longer term bond, you're going to get price appreciation there that you aren't going to get out of short term bonds.
So let's go here. I mean, when you're talking to clients and you get the slap across the face, 30%, 40%, 50% cash, I'm sure you ask or you dig into why. Is it
Correct.
just simply fear? Is there something else?
No, it's fear. It's, hey, how do you invest in the market at all time highs? It's like,
Ah, yeah.
hold on, time out. It's not the market. The market, yes, if you want to talk about the S&P 500, it's at all time highs. That does not mean there is no value out there anywhere in the investable universe outside of the S&P 500. You may believe that that's expensive. Cool. My point of this is also, listen, I'm not saying don't own stocks. By no stretch of the imagination, my personal portfolio right now sits at about 74% stocks.
Hmm.
So I talk in this kind of conservative nature, and I don't want people to misconstrue the fact that the bulk of my allocation is in stocks. What I'm saying is, listen,
Now,
we need to
I'm
diversify.
going to ask. I'm going to ask this. I don't know if you can answer it because you're a licensed advisor. When
No,
you
go
say
ahead.
74% stocks, are we? Am I to translate that to ETFs, or are we talking individual names, or what are we talking?
I buy zero individual names.
Okay,
Zero
got it.
individual names, and we could go down that rabbit hole in another conversation by all means. But that is the answer to that.
Okay.
But again, one, even if you're just looking at the stock market, beneath the surface, there are things that are priced significantly lower than that of the S&P 500. And the easiest way to look at how stocks are valued, and the one that everyone talks about, is the price to earnings ratio. And it is a
Mhm.
very easy way to compare apples to apples. For every $1 a company earns, how much is the market paying for that underlying stock?
Right.
So normalcy, if you look throughout history, is right around $15, $16 for every dollar worth of corporate earnings. Right now, the S&P 500 trades at 20.5 times price to earnings multiple, which puts it in the top 10 percentile of
Hmm.
most expensive stocks have been throughout history. When the S&P 500 sits at a price to earnings multiple of 20.5 times, over the subsequent 5 years, it has averaged a sub 4% return.
Hmm.
When stocks are expensive, the future returns are more muted. That doesn't shock anyone. When stocks are really cheap and no one wants anything to do with the market coming out of a recession, when Warren Buffett's out there buying hand over fist, right? Future return expectations are really high. There's a reason why Warren Buffett right now is running away from stocks and sitting on cash. Now, I disagree with his philosophy of literally buying cash, but at the end of the day, there's a reason. It's because stocks are relatively expensive. And I
Mhm.
know I'm talking out of both sides of my mouth here, but my point of this is you don't make wholesale changes as investors. You don't say,
Yeah.
hey, the stock market's expensive and I'm going to run the other direction, because you would have ran the other direction 6 months ago.
Yeah.
It's
Yeah.
it's
And
it's
stocks are up what?
understanding your
How much
risk.
are how much are stocks up in 6 months?
They're probably up. So year to date, the S&P's up what, 6-7%. In the
Year
fourth
to
quarter,
date.
that was
Wow.
up. Yeah, in the fourth quarter was up 14%. So in the past 5 months, call it up 20%.
Right. Okay.
And they were overvalued at that point, right? The market, there's a great word to describe the market. It's a long one, and I may have talked to you about this in the past. Enantiodromia. Enantiodromia. You
So
heard of that
word?
one?
Oh,
Yeah, and I was like, "There's no way." So my a mentor of mine taught me this word, and I was like, "Okay, I gotta Google this, but how am I gonna figure out how to spell it?" It actually is spelled perfectly with phonetics. So if you just look up enantiodromia, exactly how it sounds. But what it is it states kind of what a pendulum does. It
mm,
has a tendency to swing towards extremes,
mhm,
and then it swings back the other way towards an extreme. And you
right.
don't know where you are when that tipping point is going to be at the extreme. So it's not to sell wholesale out of stocks, but as stocks get more expensive, what you may want to do is trim a little bit and protect. And on the
Mm,
other side, cash does not protect. When the Fed cuts rates, which is when you need protection in the stock market because that's a recessionary economic slowdown, cash does nothing. Whereas
yeah.
longer term bonds go up in value.
This is exciting stuff. Again, one of the things that you and I talked about offline was that whole great cash is giving you 5%, but given Zuber, you live in California, it's really more like 2.5.
Right.
What the heck are you doing? That was a wake
Right.
up call for me. I'm like, oh yeah, that's income. I got to report that every year. That's yeah, pretty wild stuff. Uh, where can people go to find these epic rants?
Was this a rant? I think this was kind of a
No,
rant, honestly. Yeah, find us at Life Goal Investments. The rants are in 60 seconds there, and we're on both Instagram and on TikTok. It's at Life Goal Investments. Thanks,
Life
Michael.
Goal
I appreciate
Investment,
it.
folks. Go check it out. Thanks, buddy.